Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So the objective is to sell these options, take advantage of the high price premium, and as that option expires worthless, we get to keep the entire amount. So as you can see here, the strike that is sold is the 108s, and we're happy as long as the underlying security, in this case the CDD, is trading anywhere below 108 on expiration, and we run the risk of loss as the CDD trades anywhere above our break-even point. Now, we can implement the same strategy using put options. So what we can ultimately do is we can be a seller of put options. So just to go back and reiterate our strategy, on the call option, we might be neutral to bearish. So in other words, we don't expect the CDD to go anywhere above 108. Or really we expect it to stay within a specific range. Now, if we're neutral to bullish, we could in fact go in and sell. In this case, I'm showing a 103 strike option with August expiration, and we're looking to collect a premium. In this case, we're collecting 94 cents per contract, or $94. You'll notice that my option requirements are a little higher here, but my objective is that I want to collect this premium and capitalize on a decrease in volatility and a decrease in time value as we move closer to the expiration date. Now, understand that we can sell close these positions at any time. Now, our maximum profit is realized, of course, on expiration when those options expire worthless. But at the end of it all, if we see a very significant move and we're able to realize most of that premium by buying it back early, then we can do that at any time that we want to close out the position to manage for losses or to lock in profits. We can do it at any time. But we have to understand that when we're a naked option writer, we are going to have to put up a certain amount of margin. So how do we offset that margin requirement? Well, what we can do in this case is, as an alternative to simply selling that put option naked, I can create what's referred to as a bull put spread. So I can look at going in and selling my 103 strike options. Of course, you can see that I created this slide today because the CDD jumped from 103 up to 104.95. In fact, it was greater than that by the end of the day today. But ultimately, what I'm looking to do is I want to take my margin requirements off the table, and I want to be able to identify my risk. So my outlook here with my bull put spread is that I'm neutral to bullish, and I expect the CDD to stay above 103 between now and the third Friday of August. I'm going to sell the 103 strike puts, and I'm going to buy the 102 puts in order to identify my risk exposure. I'm going to collect the full premium as the options expires, and what I've done is I've created a situation where I have a limited profit, but now I have an identifiable risk exposure. So you can see by my chart here is that I really want to see this, look at the CDD, or I want to see the CDD trading above 103 on expiration. As it's trading above 103 on expiration, I'm able to capitalize on my full credit, which is that $13. It doesn't sound like a lot, but on 10 positions, that's a couple of bucks. I start to lose money as the CDD trades anywhere below, as you can see, 102.87. But my maximum risk exposure is the $87, which is the amount of capital that I'm required to put up. So the idea is that what I've done is I'm capitalizing on this rate of time depreciation. I'm still capitalizing on taking advantage of an option contract or premium that might be relatively expensive due to volatility, but I'm mitigating my margin requirements because I've now identified my risk exposure down at 102. So it doesn't matter how much below 102 the CDD actually drops, I cannot lose any more than my 87, in this case the $87 that I've put up as my margin requirement. So in this case, again, 10 option contracts, I'd have to put up $870 to make $130. So you can do the math with respect to your percentage gain. But the bottom line is my objective here is really to generate cash flow based on taking advantage of expensive options, being the seller, and ultimately looking at taking advantage of the time depreciation kicking in and working in our favor. Now, we can take this one step further, and this is the last strategy that we're going to look at for this evening, and we can create what we refer to as the iron condor. And an iron condor is simply established by selling call options, selling a call credit spread, and selling a put credit spread at the same time. So what we're looking at doing in this scenario is that we expect the pair to be range bound. So in other words, we don't think between now and August that the CDD is going to be trading below 104, and we also don't expect that it's going to be trading above 107. So what we do is we create a strategy that is going to profit as long as the pair is trading within this range. So you'll see here in this example what I've done is I've sold one 107 call option, and in order to, and normally by itself that would be a naked call, and I would collect $1.54. But because I want to make sure that I mitigate my risk on the upside, I'm going to buy that 108 strike call option. I'm going to give up some of my profit, and I'm going to collect a few cents for that particular position. Now, on the other side of it, I'm going to sell those 104 puts. So in other words, what I'm saying is I don't believe that the CDD is going to drop below 104 between now and the third Friday of August. So I'll collect $1.42, and I'm going to buy, in order to offset my risk on the downside, those 103 puts. Now, if we wanted to put up less capital for our little insurance calls and puts that we buy, by insurance I mean we're buying the August 108s and we're buying the August 103 puts, we could simply look at, instead of the 108s, we could buy the 109s or the 110s and give up less of our premium, and instead of the 103s, we could go down to the 102s or the 101s and give up less premium. So what I've done is I've kept my my strike intervals to within 1 point, just to keep our risk exposure as lean as possible. Now you can see by our chart here that I'm happy as long as the CDD, as long as the Canadian dollar, the US dollar, stays between $1.04 Canadian and $1.08 Canadian, I'm going to be happy, and I'm going to be able to capture my full profit. Now, if you look at our risk exposure here, we're putting up $54 per contract, but if we're right, and at the third Friday of the options expiration date, the pair value is trading between 104 and 107, which is a pretty decent range, we're going to make $46 or on that position. So again, multiply that by 10 contracts, and $540 is going to net you out $460 on expiration. So all we've done is we've taken two credit spreads, we've put them together, and we've created an iron condor. You can see that I'm making money as the pair is trading within a certain range. My maximum profit is when it's within my range, and I begin to lose money as it starts to go outside my range.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.